Okay, so now let's talk about mortgages and how they're set up. Moving away from why housing prices were so inflated to thinking about the ramifications. So basically, what we saw in the first video is how we were developing this perfect storm of events. What you'll see now is how that will unfurl and ultimately collapse. To understand why, let's start by thinking about the two different types of mortgages. In reality, there's a lot of different mortgages, but there's two very common types. And one of these is called a traditional mortgage. And this is what I've done with the houses I've bought. I've used a traditional mortgage. There's a good chance you'll buy a house using a traditional mortgage as well. A traditional mortgage is a mortgage with a 20% or greater down payment. Now, I'm sure you know what a down payment is, but just in case you don't, a down payment is kind of like a deposit on your house in a way. It's an amount that you pay on a mortgage to basically indicate your ability to repay a loan in the future. It's a signal, okay? So for example, just to give you a taste of this, if you buy a $300,000 house, you'll have some options in regards to your down payment, okay? As it turns out, the 20% level is a really popular level because if you can give a 20% down payment, you'll essentially lock in the lowest possible interest rate, all right? So in the case of this $300,000 house, a lot of people would choose a $60,000 down payment. They don't want to do less than that because if they do less than that, they'll have to pay something called PMI, private mortgage insurance, which means that basically they have to pay extra money to compensate the banks for giving them a risky loan. Typically, people won't do more than 20% because often there's no reason to. If you go above 20%, it doesn't reduce your interest rate, so there's not really a big advantage in doing more than 20%, okay? So what you'll see is if you can look at all the data of a bunch of houses being sold, you'll see a bunch that have mortgages with a 20% down payment, all right? So in this case, you'll do a $300,000 house. You buy that using a bank. You have $60,000 down payment, and then you would owe $240,000. There's two really important aspects of this down payment, two things that it really provides. And that is, one, that it only allows it only allows responsible borrowers on average. This is not universally true, but generally speaking, these are going to be responsible borrowers. Because if I go to a bank and I'm looking to buy this house and I have $60,000 saved up in liquid assets, that shows that I probably had a job for a long period of time. I have the ability to save money. Or maybe even if it's not me, maybe I got this money from my parents. Well, maybe I have rich parents, okay? So basically, a person that has $60,000 down is probably the type of person that you really want to lend money to, okay? Flip that around. Imagine if somebody comes to the bank and they're like, I want to borrow $300,000 and I have no money saved up. That's a risky borrower, okay? So someone who has 60 grand, pretty safe. So that's one reason why this is important, the down payment. It changes the type of person that could get a loan. The second thing it does is it incentivizes repayment. If you fail to make payments on your house, so if right after I get this mortgage, I fail to make payments on this house, I lose the house. The bank will take it from me and they'll sell it, a foreclosure, all right? Think about what I'll lose there. If I stop making my payments, I essentially have just put $60,000 down on the house that is gone, okay? I don't get that money back if I default. So that incentivizes me. The fact that I put $60,000 down is going to incentivize me to make my payments because I don't want to lose all that money that I've already put in. So this will do two things. It gets you really good borrowers and it encourages them to repay it. To borrow some economics terms that maybe you know, I won't test you on this, but This reduces the adverse selection by getting you good borrowers. And this reduces the moral hazard because it makes you more likely to feel incentivized to pay. So if we go back to the 1950s, you're going to see a lot of these mortgages. 1960s, a lot of these mortgages. But they decrease over time, okay? These are still really common. Still lots of people buy using these mortgages. But a 20% down payment is tricky for a lot of people. So let's talk about the effects of rising housing prices. Rising housing prices do several things. One, it incentivizes buying now, even if you don't have the 20%. Right? If you know that housing prices are always going up, you might not want to wait to have that 20% saved up. And that's a pretty defensible position, I think. If you're moving to Atlanta, I could totally understand why you wouldn't want to wait until you have 20% down to buy a house. Because you're thinking if housing prices are going up $100,000 every couple of years, you're going to have a hard time catching up to the down payment. You're going to have a hard time saving that amount because it's increasing. It's an increasing target. So if buying prices is going up, you might not want to wait to reach that down payment savings level, okay? Secondly, just from a mathematical standpoint, 20% of a higher price is a higher down payment. So if housing prices go up from $300,000 to $50,000 a year, that increases the necessary down payment from $60,000 to $100,000 to get a traditional mortgage. So for two reasons here that we've already begun with, when housing prices go up, people are going to want to buy now, regardless of how much they have saved. And secondly, fewer are going to be able to afford the 20% down payment. So they're going to look for other types of mortgages beyond the traditional type. Third, when housing prices rise, banks always profit. We made note of this in the last video, but I want to make sure we understand why. There are two results of a mortgage. One, if you're a bank, you could receive your pay in full. So you loan money to somebody, they pay you all the way back. Great. You made a profit because you were charging them interest. But the other possibility is you get a default and a foreclosure. And the amazing thing about the second scenario here is, in the case of 2000, 2003, 2005, really most of history prior to 2007, this is actually more profitable than receiving your payment in full, okay? If you receive your payment in full, you get the interest, but that's all you get. If you do a default, if somebody stops paying you, then what you will receive is the down payment, any other payments that have occurred. All right, so for example, on that $300,000 house, if I pay a $60,000 down payment, I pay for 4 or 5 years on the house, and then I default. The bank will get the down payment, the payments that I've made, my monthly payments, and then they'll get to sell the house likely at a higher price than they paid for it. So if you're a bank, this is looking like an amazing deal. This is a really bad incentive, okay? Think about the incentive now that the bank has. If somebody pays them in full, they make a profit. But in 2005, they've learned that people default, they earn even more profits. So this makes the banks go a little crazy. They want to do as many mortgages as possible, but they specifically want to target these group, the people who are risky. Okay? So they're going to target risky borrowers, which is going to be bad news. That is what's going to really set this disaster course we're on really into overdrive here, when they start doing these risky loans on purpose. Let's think about what this would look like. historically, let's say you've been a very safe bank and you've been just doing traditional mortgages. Well, you can continue doing traditional mortgages, and they all do. They're still going to do traditional mortgages, but these might not be the best, all right? Because as we just learned, when people default, the banks actually make more profits. So what they'd actually like to find is people that are risky. So you got all these people out there really wanting to buy houses as quickly as they can because they're thinking housing prices are going to go up. You've got the banks wanting to lend money to risky borrowers. So what the banks do is they become increasingly reliant on a different type of mortgage called an FHA loan. FHA stands for the Federal Housing Authority. This is actually a governmental program that was aimed at allowing people in lower classes to buy houses. Understanding that it's hard to get it to a 20% down payment, the FHA loan allows more people to have access to the potential of buying a house. Okay, could be a good program, but it's going to be a problem in this case. These have a down payment of 3.5% at a minimum, okay? And also you're going to pay that PMI that we talked about before. PMI usually is about 1% of the housing price per year. So if you buy a $300,000 house, you're going to end up paying about an extra $3,000 in the first few years of that mortgage just to the insurance. That insurance eventually does go away. I don't want to get too personal financy here, so I don't think that's such a big deal. What you really just need to focus on here is the down payment being 3.5%. All right. So now, if you buy a house that's $300,000, the down payment is only going to be $10,500 there, if I'm doing the math right. Okay. So what this does is it basically allows riskier borrowers to start borrowing for houses. And this program has existed before, but as you'll see here right now, these types of mortgages became way more common during this period. Okay, so first let's look at the average interest rate on 30-year mortgages, and you can see this rate has dropped basically monotonically for many, many years now. It's become cheaper and cheaper to buy a house. And we talked about why this is the case. That extra money coming in from China, low federal funds rates, etc. So those interest rates are really low. That's going to contribute to raising those housing prices. And you can see here now, talking about down payments, I really like this graph because it breaks it up between first-time buyers in yellow, and the red up here, or a little purple color, is the repeat buyers. Okay, so these are people that have bought a house before. And so what you can see is people who have already bought a house, this is, by the way, this is their down payment rate. It's not an interest rate, it's their down payment rate. So what this is telling you here is, you see, for people who've already bought a house, looking at like the late 90s, the average down payment rate is close to 20%. And that's because a lot of them are doing traditional mortgages with 20% down payments. You can see that the average goes up to 25% at one point. So these people are doing mortgages with big down payments. On the other hand, first-time home buyers have much lower rates. So you're going to see a lot of FHA loans in here. And you can see the trend, especially obvious here with the first-time home buyers. This average rate is dropping through time as we go up to the Great Recession. And look at this. In 2005, the average down payment rate was 2% on a house for first-time home buyers. 2%. That's below the FHA loan mortgage rate, down payment rates of 3.5%. So what's going on there is you have people doing what are called VA loans, veterans loans. There's some USDA loans. Not really important topics for this class, but it just goes to show that down payments were incredibly low. These are very risky borrowers because if you had more money, you wouldn't be borrowing at a 2% down payment rate. And this is going to mean that the types of homes that people are owning come 2008, 2009, 2010, you've got all these risky borrowers. And when the economy turns south, those risky borrowers lose their jobs and they can't afford their payments anymore. So we've got these housing prices really built up. We also have this disaster scenario where you have lots of risky borrowers who just bought houses. And in 2007, housing prices dropped. as the economy hits a small downturn. I've learned in the past that students often want to know what caused this downturn, and we don't really know, and also we don't really care. Small economic downturns can happen all the time. A few years back, it was just really cold, and we had an economic downturn just because it was cold, okay? You can't go to work if it's like super cold and snowing. So we have a small economic downturn. It's not really a big deal, but what that does is it drops prices, all right? This is going to create a chain of disastrous events. So let's think about our mortgages out there. You've got some people with traditional mortgages. So you know a $300,000 house has that down payment of $60,000. And so these people owe about $240,000. Okay? Now, this is how much you'd owe right after you did the mortgage. But the unique thing about 2007 is we had so many people who had just engaged in a mortgage. We had so many new houses being sold. When I say new houses being sold, they could have been old houses, but they're new to the buyer, okay? So there were so many new mortgages processed in like 2005, 2006, 2007, that there were a lot of people who had just bought a house. So it looked like this. You also had tons of FHA loans, or in some cases, those 0% down payment loans. In the case of FHA loans, a $300,000 house would have a down payment of $10,500, meaning that this person would owe $289,500. Okay? So you can imagine a neighborhood that has, a few people like this and a lot of people like this. Okay? And let's draw the housing market out and let's see if we can think about the repercussions of a decrease in the housing market. So here's the housing market. It's not going to work. Here's the housing market in the latter stages of 2007. I'm not going to worry about what caused this housing price decrease, but what you can kind of imagine here is that when the housing price goes down, it might go down to $280,000, right? These houses that they once paid $300,000 for, maybe just a couple of months ago, are now worth about $280,000, okay? Now think about the situation each of these people are in. The traditional mortgage, all right? This person's probably really safe. They had $60,000 saved up, so they're probably safe. They probably have more savings than that available. They probably have like an emergency fund, a 401k, IRA. They're really safe people, okay? They're probably older. They've probably been working at their current job for quite a while because after all, if they have that much money saved up, they're probably older and later on in their career, right? So this person's really stable. So when there's a slight economic downturn like we saw in 2007, this person will not be directly affected. They will not lose their job or anything like that because they've been with the company for a long period of time, right? Companies don't usually fire long-term employees just because of a small economic downturn. On the other hand, think about this person here. This person probably really risky. Okay, the reason they're risky is because, if they had been not risky, they probably would have more than $10,000 saved up. So this $10,500 that they've saved up is probably most of their savings. They were probably saving with the intent of doing one of these mortgages. And right when they reached the amount that they needed, they immediately did a mortgage. That's what people were doing in like 2005, okay? They were getting houses as soon as they were legally allowed to get one. So they probably don't have any extra money saved up. They're also probably young. Their credit score is probably pretty low. And also they've probably been at their job for not a very long period of time. So when you have this small economic downturn, businesses are likely to be laying off this type of person more readily than they are this type of person, right? This person's been at their job for 5 years. They're established. This person's been at their job for 6 months. And when companies lay off employees, they usually lay off the new ones first. So think about these two situations. On the surface, this person sees housing prices go down a little bit. They don't even care. They're not even paying attention. No big deal, okay? But think about this person. They just lost their job, okay? They have no way to earn income. their credit score is already really low. So it's not like if their credit score gets hurt, they're going to like have a big drop. It's already low to begin with, probably. And they're now in this interesting situation where they owe $289,000 on their house, but their house is only worth $280,000. So effectively, at this moment in time, if they keep making payments, they're paying more for their house than their house is worth, okay? So this puts people in a scenario where they are underwater on their mortgage, or sometimes this is referred to as upside down, which means that they owe more than the house is worth. Now, in a normal economic time, this can occasionally happen, and normally these people wouldn't really care. They wouldn't even know this is happening. But because of this small economic downturn, the fact that they're underwater is going to incentivize them to stop making payments, right? Why pay $289,000 for a house? It's only worth $280,000. You just lost your job. It's going to be really hard to scrape together these payments. So some people were forced to stop making payments because they lost their job. And some chose to stop making payments because it wasn't financially worth it anymore. So these people here will intentionally default. So thinking about the steps that we have here. Prices go down in the housing market initially because of the fact that we had a small economic downturn. The economic downturns generally make housing prices drop. Housing prices are very sensitive to the economy, okay? So housing prices drop. As a result, some people go underwater. And some of these people, now I'm not saying all of them are going to do it, but you can imagine maybe you get 0.25% of people in this market choose to default. All right, they default on purpose. Some default because they're losing their job. But regardless, you get more defaults. Now, what does a bank do with defaults? Sells it, right? Takes that house and it sells it. So we get a foreclosure. And the way I show that on my graph is via an increase in supply. When the bank takes the home, they sell it, increasing the supply in the market, driving down the price. Maybe you can see where I'm going with this now. Okay, again, when the bank takes the house and they sell it, that increases supply and it pushes housing prices down. Anytime you see an arrow in economics point back to the start, that means we've got this cycle going on, okay, like a feedback loop. Once this starts, it's just going to continue, okay? So let's go back to the beginning. Small economic downturn, prices go down. We got tons of people who are doing these FHA loans in the early 2000s because everybody's trying to buy a house as quickly as possible, right? Everybody expects housing prices to go up, so they want to buy houses as fast as they can. So when prices go down, these people go underwater first. Some of them default on purpose. Foreclosures, banks take the home and they sell it. When the banks sell the home, that floods the market with houses. Prices go down. People go underwater on mortgage even more. More people default. The banks take the home, they sell those. And so this supply is going to keep increasing, increasing, and increasing. You know, maybe to the point where prices go to $200,000. At this point, even the person doing the traditional mortgage is underwater. So once housing prices dropped some, they were destined to absolutely collapse. And on top of all this, the only reason housing prices are so high is because people expected it, right? They were speculating that housing prices would go up. Speculation can turn the other way very quickly. If people don't expect housing prices to go up anymore, prices can drop very fast, okay? And that's exactly what happened. So during this period, housing prices dropped amazingly quickly after increasing in value at an incredible rate right before this. So this was a really big change. Housing prices are exploding up, and then they very quickly collapsed in 2007. Let me show you some data. So this is the graph of housing prices in the United States. The blue data you see here, this is the percentage change at an annualized rate. So what that tells you is, for example, in 1994, housing prices were going up about 2.5%, 3% a year, which is typical. And then you can see from like 1997 on, housing prices are increasing at an increasing rate. All right, so in 1998, they're going up about 6%. 2000, they're going up about 8%. 2002, you get a little drop there. That's that 2001 recession. But then we rebound right back up. And at one point, housing prices are rising at an annualized rate of 20% per year, which is very unusual. This red line shows you housing prices in general, all right? So this is not the percentage change. This is just the housing price index. And you can see that increasing at an increasing rate, right? Positive slope, and it's increasing at an increasing rate, which means the second derivative is positive, okay? So basically, housing prices are exploding. And you can see there right around 2006, 2007, we get a little hump and then a collapse. Housing prices now are dropping at an annualized rate of 10% a year or so. And you can see prices drop substantially. It wasn't until about 2017 that we got back to our previous peak. And so you can see that bubble. If this dotted line is the trend line of housing prices, you can see how we got way above that trend line in 2006 and 2007. So you see a big rise and then a quick collapse in housing prices. Okay, so just to close this up here, all right, going all the way back to the beginning, we had this huge increase in housing prices. Thinking about that general equilibrium theory that we started with, outside events, things that don't have anything directly to do with the housing market, cause the housing market to get really inflated. Specifically, it was that trade deficit that we had with China is really being an instigator for housing prices, as we saw. So housing prices went way up. As housing prices were going up, banks were willing to lend to very risky borrowers because they figured if people default, they can always sell the house. And if housing prices are going up, they'll sell the house at a higher price than they bought it for. So they start doing those super risky loans, okay? So this becomes an entire economic collapse for one simple reason. The thing you need to recognize is the majority of houses owned in the United States are owned by banks. Banks own the homes. And so when all of those foreclosures occurred, you have this massive liquidity crisis, okay? When people stop making payments, obviously, we'll get a foreclosure. But if you're selling the house for way less than you initially lent to the borrower, then you're going to be losing money, okay? So you can imagine in 2006, you lend $3,000 for a house, or using our example from before, you lend $289,500, right? That would be for an FHA loan on a $300,000 house. But come 2007, you sell the house for $140,000, right? Well, then this is negative profits. And you're not just doing that for one house. Banks were seeing this for huge portfolios of houses. And it wasn't just the banks. Remember those CDOs and those mortgage-backed securities? Tons of investors have been investing in those. In some cases, like retirees, were unknowingly investing in very risky collateralized debt obligations. If you took my class in the past, we talked about CDO squared in the past. So they're investing in those super risky mortgages, okay? And so the collapse here basically destroys the banks. So most banks, literally most banks, would have collapsed. If we had done nothing. If you guys recall classical economics, we discussed that like first or second class. Classical economists believe that if there's a recession, you should do nothing. The government really shouldn't get involved. That was not an option here. All of the banks would have collapsed. And if banks collapse, that's just such a big problem. You know, you're going to your bank, you're trying to get money out, it's not there, the bank is gone. There's something called FDIC insurance, which means the government will cover that, but now the government's going to have to cover all of these deposits. Oh my goodness, what an entire collapse this would have been. What a disaster. And so the government and the Fed had to get highly involved to try to fix this. The government basically just spent a bunch of money, about $800 billion trying to fight this. It's called the American Recovery and Reinvestment Act, spending on all kinds of different entities. They spent money at Georgia College. Basically, they were trying to get money out there in society throughout the country. So there's all these little grants that happen throughout the country on top of some big governmental programs. And the Fed, the Federal Reserve, spent even more, about $1.5 trillion or so. So about double what the government spent. And we may circle back and talk about this more in the future. I haven't quite decided yet. But it was a long time before we recovered from this recession. So when we think about the legacy of this recession, we learned that the housing market and the financial sector are an area of significant concern when it comes to collapses. We learned how we have to really think about general equilibrium theory when we're considering our markets, okay? Normally you would think the housing market is a free market. You can let it just roll however it wants. But it got overinflated in this case, okay? Maybe if the Fed had kept the federal funds rate higher, we could have avoided this. Maybe if China hadn't devalued its currency, this wouldn't have happened. Maybe if we'd had more strict guidelines on CDOs or down payment rates. So there's a lot we could have changed, a lot we could have learned from this recession. But ultimately, it was really expensive. The debt that we're incurring from this is still growing today because of the interest that is accruing on these payments. So this was a really devastating recession. And it took us a really long time to recover. It was only about 2013, 2014 where we really started to feel like we were back to normal in the United States. So I can tell you guys, as an adult that was living through this, it was a really bad economic time. 2020, 2021 have been rough. Economically, this felt worse, let me tell you. So we have one recession obviously since this, but this was the last really bad recession we went to. The unemployment rate reached 10%, which is really high. We've only been to that level once or twice in U.S. history. So this was a devastating recession, and it's really the housing market, the banks, financial system where it originated. I hope that makes sense. When I send out an email, I'm going to include some other resources you should check out. Make sure you work through the worksheet, and we'll see you guys soon.